I want to bring in David Nelson now. He's a chief strategist at Belpointe Asset Management for this market conversation. David, always great to have you here with us. I want to start with the first thing that you have in your note, which is 9 months later and then a scary look at the coronavirus, essentially. We have seen a lot of volatility in the markets. We've seen a lot of down days, sell-offs as the Delta variant continues to concern investors. What kind of headwind do you think that the Delta variant is going to play moving forward, especially as we've seen some lockdowns in China being reintroduced because of those cases that are happening there? Of course, those oil markets being spooked by that.
Well, obviously, if you turn to shutdowns, then obviously the markets are going to pay for that. But to your point, it's exactly 9 months ago that Pfizer introduced the vaccine, and we've had kind of this steady run higher in the S&P 500. And actually, in the broad indices, it was kind of a narrow channel all the way up. But as we know, as market observers, underneath the surface, it was a ferocious battlefield. Take your pick, big versus small, growth versus value, secular versus cyclical. Just about every asset class weighed in on this, depending on the economic recovery. And the one data point that we've looked to as kind of a guiding light as to what the market was going to do on any given day was 10-year yields. Earlier in the yield, they rose. The reflation trade worked out. Financials screamed. And then they started to stall because we started to get concerned about peak growth. We're going to have a 60% coming into this quarter. We're going to look like we're going to print 90% is what the growth is going to be for this quarter. Obviously, that's peak. Each successive quarter from here is going to have to be lower. So we're going to have to digest that and see where we are in the next couple of months.
All right, well, David, you used a lot of those buzzwords there about reflation and then peak growth. So what would you call the next chapter, right? I mean, we're seeing 10-year yields kind of settle as of the last few days. I mean, it's up about 3 basis points just today, but, somewhere around, let's say, the 120 to 130 range. So what is the story going to be in the future? Is it the Fed tightening? Is it going to be just Delta shutting certain corners of the world down that might, actually provide more inflationary pressures? What do you think is the big story?
Obviously, the Fed is always a big story because we key off that. In a vacuum, the lower yields would be a concern for me. But, it was pointed out to me on my desk that if you look outside the United States, we're the best house on the block. In Germany, the entire yield curve is underwater. In Japan, you've got to go out beyond 10 years just to get a positive rate of return. So in that backdrop, it's not surprising so much capital has literally poured into this country, into our fixed income markets, and eventually that finds its way into other asset classes like stocks. So relatively speaking, I'm not as concerned as I was earlier in the year when I started to see yields falter there.
Now, David, just a moment ago, you were really describing, essentially, if you pull back the curtain on that market action, that there's a battlefield. There's an entire war that is happening really behind the scenes. So then I have to ask, essentially, do you think that battle is going to be continuing over the next couple of months? And who are the winners going to be?
Well, I can tell you where not to go. I think everybody can win. I think the United States is still the better place to be. My concern is that as we push the edge of the envelope in valuation, we can make that case that a lot of investors will start to look to emerging markets because of the valuation differential. And I call that, actually, that's the emerging market lie. People underestimate how important the rule of law is. And we've seen that play out with China, not just in Hong Kong, but here in the United States with a clampdown on a lot of securities here. Now there are other very risky structures out there in the emerging markets, like these variable interest entities. And just about everybody owns them. If you own Alibaba, Baidu, and a lot of these U.S. listed firms, emerging markets are problematic. So stay here in the United States. It's a safer place to be.
Now, David, something that's interesting is just what's been going on with the Chinese listed shares domestically here in the United States. And obviously, people who have been watching, Baidu or specifically DD stock is fully aware of that situation. But there might be some investors, maybe even the Robinhooders, who are looking at that and saying, well, is it possible that these huge tech companies can go back up? What do you think about Chinese listed companies that have become a bigger story when it comes to investing here stateside?
I have no problem with the common shares, but people need to understand what they own. If you own Alibaba, you probably think that you tapped into the Chinese economy and the growth of these very, very exciting companies. In fact, you own almost nothing. You've invested in a Cayman Islands entity that has a contract with these companies for some of the economic interests. China could change the rules on that at any point in time. What would make these go up is if there was some kind of meeting of the minds between President Biden and President Xi, and we came out with some kind of kumbaya moment. But the downside is unmeasurable in these securities. Think long and hard before you add these to your portfolio. They could go up 40% overnight, but they could also go to zero.
All right, David, I want to ask about the labor market. You know, we got those JOLTS figures out, hit that record high, 10.1 million. Of course, on Friday, we got really large headline print for the jobs report for July. Now, we've been talking with folks, Octavio Morenzi, last week, pretty much saying that if the markets see a lot of strength in the labor market, that they're going to get a little bit spooked, because that essentially is what the Fed has been looking at least when it comes to their conversations around tapering and pulling some of that easy money off of the table. Are you sharing some of those same fears that strength in the labor market, while we might see some pops, and we did see some rallies, record highs in the markets on Friday, that this could essentially cause the markets to do a bit of an about face moving forward?
You know, good news suddenly becomes bad news, and that's what investors deal with all the time. And everybody wants a good thing; they just don't want too much of it because they think the Fed is going to take away the punch bowl. I think Jay Powell's made it pretty clear at this point that they want to push this as long as they possibly can. But I actually got a note from a client this morning about some of the pricing that they're seeing. They're a shipping broker, and they're telling me that containers in Shanghai, going outside of Shanghai, from December, $5,500 per container, that's now over $22,000. So to say that inflation right now is transitory, that's going to be a tough sell 6-7 months from now.
All right, David, I mean, lastly, what's your prediction for the consumer price index print that we will get on Wednesday? Do you think that it could have an upside surprise? And if so, do you think markets will blink?
We seem to take everything in stride, no matter how hot the number is or how cold the number is. We seem to translate it, well, it's bullish in here. And I guess it's because equities are really the only asset class in town right now. We don't want to go outside the United States. We're still the better place to be, despite our valuation differential. And bonds, we probably overshot on bonds on the downside in terms of yields. I have to believe the next leg has to be higher in fixed income. And that becomes problematic once we get above 2%. So we'll see what happens on Wednesday when we get that number. My guess is we'll probably turn it into a positive story somehow.
We'll have to chat with you after that happens. David Nelson, Chief Strategist, Belpointe Asset Management. Always great to have you here, David.